What if I told you that one three-digit number could decide whether you buy your dream home, drive away in a brand new car, or pay thousands of dollars more in interest, without you ever realizing why? That number is your credit score. And here's the shocking part. Millions of Americans think a credit score is based on how much money they make. It's not. You could earn $250,000 a year and still have terrible credit. At the same time, someone making just $60,000 could qualify for lower interest rates, better credit cards, and easier loan approvals. So how does that make any sense? Today, we're breaking down exactly how credit scores really work, from 300 all the way to 850. You'll learn what every score range means, what actually affects your score, and the biggest mistakes that silently cost Americans thousands of dollars every single year. By the end of this video, you'll understand the same system banks use before deciding whether to trust you with their money. Let's get started. The first thing you need to know is this. Your credit score is not a measure of your income. It doesn't care how much money you make. It doesn't care how expensive your house is. It doesn't even care how much cash you have sitting in your checking account. Instead, your credit score answers one simple question: how likely are you to pay back borrowed money on time? That's it. Every bank, credit card company, mortgage lender, and auto lender wants to know the same thing. If they lend you money today, what's the chance they'll get every dollar back? Your credit score is simply a prediction based on your financial behavior over time. Think of it as your financial reputation. Just like an employer checks your work history before offering you a job, a lender checks your credit history before offering you money. Now let's talk about the famous numbers. Most credit scores range from 300 to 850. If your score falls between 300 and 579, it's generally considered poor credit. Getting approved for loans becomes much harder, and if you do qualify, you'll probably pay much higher interest rates. A score between 580 and 669 is considered fair. You'll have more borrowing options, but lenders may still see you as a higher risk borrower. A score from 670 to 739 is considered good. This is where many Americans begin qualifying for competitive loan offers and better credit card rewards. Between 740 and 799 is very good. At this level, lenders usually see you as a dependable borrower, making it easier to qualify for lower interest rates. And if your score is 800 to 850, you've reached the excellent range. This is where borrowers often receive some of the best financing offers available. But here's something most people never hear. You don't actually need a perfect 850 to unlock excellent financial opportunities. In many cases, a score in the upper 700s can already qualify you for many of the best available rates, depending on the lender and the type of loan. So if your salary doesn't determine your credit score, and having money in the bank doesn't automatically improve it, what actually controls those three numbers? The answer comes down to 5 key factors. And one of them is far more important than all the others. The biggest factor is something almost everyone has control over: your payment history. This makes up the largest portion of your credit score because lenders care about one thing more than anything else. Do you pay your bills on time? Every time you make an on-time payment, you're building trust. Every late payment tells lenders the opposite. Imagine two people applying for the exact same car loan. Both earn $80,000 a year. Both want to borrow the same amount. The only difference: one person has never missed a payment. The other missed 2 credit card payments last year. Who do you think the bank trusts more? Exactly. Even a single payment that's more than 30 days late can significantly lower your credit score and remain on your credit report for years. That's why one of the easiest ways to protect your credit is by setting up automatic payments or payment reminders. Now let's talk about the second biggest factor: credit utilization. This sounds complicated, but it's actually very simple. Credit utilization is the percentage of your available credit that you're currently using. Let's say your credit card has a $10,000 limit. If your balance is $1,000, your credit utilization is just 10%. That's generally viewed as responsible credit management. But what if your balance jumps to $9,000? Now you're using 90% of your available credit. Even if you pay the bill on time, lenders may see you as someone who's relying too heavily on borrowed money. That's why many financial experts recommend keeping your credit utilization below 30%. Some people aiming for excellent credit try to keep it below 10%. The third factor is the length of your credit history. The longer you've responsibly managed your accounts, the more confidence lenders have in your borrowing habits. This is why closing your oldest credit card isn't always a smart move. Even if you rarely use it, that account may be helping increase the average age of your credit history. Sometimes keeping an old account open can be more beneficial than closing it. The fourth factor is your credit mix. Lenders like seeing that you can responsibly manage different types of credit. That might include a credit card, an auto loan, a student loan, or a mortgage. This doesn't mean you should borrow money just to improve your score. It simply means responsibly handling different types of credit can strengthen your overall credit profile over time. Finally, there's new credit inquiries. Every time you apply for a new credit card or loan, a hard inquiry may appear on your credit report. One inquiry usually isn't a big deal, but applying for several credit cards or loans within a short period can temporarily lower your score and make lenders wonder if you're under financial pressure. So if these are the 5 factors behind your credit score, why do so many Americans still make costly credit mistakes? Because there are a few common myths that sound believable, but can actually hurt your score instead of helping it. Let's separate fact from fiction. Now it's time to bust some of the biggest credit score myths that millions of Americans still believe. And some of these myths could be costing people thousands of dollars. Let's start with myth number 1. Checking your own credit score lowers it. This is completely false. When you check your own credit score through your bank, credit card company, or a trusted credit monitoring service, it's called a soft inquiry. Soft inquiries do not affect your credit score at all. The only time your score may temporarily change is when a lender performs a hard inquiry after you apply for new credit. Knowing your score is actually one of the smartest financial habits you can build. Now let's look at myth number 2. Carrying a balance on your credit card helps your credit score. This is another common misconception. You do not need to carry debt from month to month to build good credit. In fact, paying your statement balance on time can help you avoid interest charges while still demonstrating responsible credit use. Banks don't reward you for paying interest. They reward consistent, responsible repayment behavior. Here's myth number 3. Closing old credit cards always improves your credit. Not necessarily. Closing an old account can reduce your total available credit and may shorten the average age of your credit history over time. Both of those changes can affect your credit score. Unless the card has high annual fees or no longer fits your financial needs, keeping an older account open may sometimes be beneficial. Now here's a myth that surprises many people. A perfect 850 credit score should be everyone's goal. The truth is, an 850 is impressive, but it isn't required to qualify for excellent financial opportunities. Many lenders already offer their most competitive rates to borrowers with scores in the high 700s or above, depending on the loan and lender. Chasing a perfect score shouldn't be your priority. Building healthy financial habits should be. Now let's see how all of this works in real life. Imagine 2 neighbors. Sarah has a credit score of 790. Mike has a score of 610. Both want to finance the same $35,000 vehicle. Sarah qualifies for a much lower interest rate because lenders see her as a lower-risk borrower. Mike, on the other hand, may be offered a significantly higher rate. Over the life of the loan, that difference could mean paying thousands of dollars more in interest, even though they're buying the exact same car. That's the real power of a credit score. It doesn't just affect whether you're approved. It can affect how much borrowing costs you over time. And that's why understanding your credit score isn't just about numbers. It's about keeping more of your own money. So the next question is, if your credit score isn't where you want it to be today, how can you actually improve it? The good news is that there are practical steps you can start taking right away, and some of them are much easier than most people think. So how do you actually improve your credit score? The good news is, you don't need a secret strategy. You don't need to be wealthy. And you definitely don't need to wait years before seeing progress. The biggest improvements usually come from consistently doing the basics. The first step is simple. Always pay your bills on time. This is the foundation of a strong credit score. Even one missed payment can have a meaningful impact, while a long history of on-time payments builds trust with lenders. If remembering due dates is difficult, set up automatic payments or calendar reminders. Next, keep your credit card balances low. Just because your card has a $10,000 limit doesn't mean you should use all of it. Lower credit utilization generally signals that you're managing credit responsibly. Another smart habit is to avoid applying for several credit cards within a short period. Every hard inquiry may have a small temporary effect, and too many applications can make lenders question why you're seeking so much new credit. Instead, apply only when you genuinely need new credit. Another important tip is to regularly review your credit reports. Mistakes can happen. An incorrect late payment or an account that doesn't belong to you could affect your credit history. Reviewing your reports gives you the chance to identify and dispute errors if they appear. Building excellent credit isn't about making one perfect financial decision. It's about making good decisions consistently over time. Think about it like going to the gym. One workout won't transform your body, but hundreds of workouts over months and years create lasting results. Credit works the same way. Small, consistent financial habits often matter more than occasional big moves. Now let's look at what happens when you ignore your credit score. Imagine two people graduating from college. Both get similar jobs. Both earn similar salaries. The first person pays every bill on time, keeps credit card balances low, and avoids unnecessary debt. The second person misses payments, maxes out credit cards, and ignores monthly statements. 5 years later, their incomes may still be similar, but their financial lives can look completely different. One may qualify for lower borrowing costs and more favorable financing options. The other may face higher costs whenever they borrow. That's why your credit score isn't just a number. It's something that can influence major financial opportunities throughout your life. And before we wrap up, there's one final lesson that almost everyone gets wrong, and it's probably the most important takeaway of this entire video. The biggest mistake people make is believing that a credit score is the same thing as financial success. It isn't. A high credit score doesn't automatically mean you're wealthy. And a lower credit score doesn't define your future forever. Your credit score is simply a tool. It measures how you've managed borrowed money in the past. Nothing more, nothing less. The real goal isn't chasing a perfect 850. The real goal is building healthy financial habits that help you create long-term financial freedom. Pay your bills on time. Keep your credit card balances under control. Avoid taking on debt you don't need. Review your credit reports regularly. And give your credit history time to grow. Those simple habits can make a much bigger difference than trying to find a quick shortcut. Remember, your credit score can influence the interest rate on your mortgage, the cost of your car loan, your ability to qualify for new credit, and in some cases, even certain rental applications. That's why understanding how the system works can save you money for years to come. Here's the most important takeaway from today's video. Don't let your credit score control your life. Learn how it works, use it wisely, and make it work for you instead of against you. Because every on-time payment, every smart financial decision, and every responsible choice you make today is helping build the financial future you'll live tomorrow. If you found this video helpful, make sure to hit the like button and subscribe for more simple, practical videos about personal finance, credit, investing, and building long-term wealth. Thanks for watching, and I'll see you in the next video.